Welcome to the Cordier Commodity Report, where James Cordier breaks down what's really driving gold, silver, oil, and the global economy. We'll go beyond the noise to explain the cycles, data, and signals behind major commodity moves. Hola, I'm Joe Pardavila. Let's get started. James, how are you, sir?
Joe, I'm doing quite well. How about yourself?
I'm excellent, and I want to be clear to anyone watching this on YouTube that you and I did not coordinate outfits today. We did not plan on wearing the black long sleeves today, but it just is what it is.
You know, it's cold everywhere and it makes you feel a little bit warmer, here in the beginning of February. Even in Florida, I guess it snowed not so far from here the other day. So global warming, I'm not so sure about that, but I'm sure that'll get a revival this summer when it gets hot out.
Absolutely, yes. And I spoke to your wife and your struggles with the cold. I lit a candle for you over the weekend, so I'm glad you're both doing well and surviving in Florida. I wanted to pick your brain about something real quick because people know you from popping on to these business shows like CNBC and Fox Business. What do you think people misunderstand about how much work sits behind a single market call? Because I think sometimes they see the pretty face of James Cordier popping in, thinking like, you're just shooting from the hip, feeling good. But like, how much work goes behind those single market calls?
Joe, interestingly, something came up this past week. For example, generally speaking, you're watching CNBC or Bloomberg or Fox, and if the talking head comes on and says gold's going higher, you just keep betting on it to keep going higher. Silver, which was trading, at $50 an ounce the middle of last year, peaked all the way up to $120 an ounce. Gold, which was no one would think would get above 3,000, it traded at 5,500 this past week. A lot of times people are just following trends. They're looking at indicators like stochastic and relative strength index, and those can be good barometers. But we have found a technical indicator that can practically be a treasure map. And that is something called open interest. And open interest is something not a lot of people follow, very few people talk about, but it's kind of the breadth of the market. And what it tells you is the buying that's going on in gold, for example, the last few weeks. Was it new longs and new investors and new money coming in, propelling it to higher prices? Or was it people who had made bearish bets that were buying their way out of the market? And late last week, we were watching open interest. Gold was going up $50 and $100 a day, all on short covering. Buying that was taking place by previously shorted bets, and they were bailing out of the market. 6 days in a row, open interest fell about 25%. And that told us that is like the worst type of buying. We were on CNBC Dubai late last week. We described it and explained it to the viewers there. And we made quite a lucky call saying that it was time to get out of gold. And sure enough, the following day, it made its largest historic one-day drop in history.
Wow. And you don't trade headlines, you trade structure and cycles. Let's either go back a little bit or go back way far, but where did that discipline come from?
Joe, interestingly, growing up in the Midwest in a middle-class family, I learned at an early age that I was going to be earning money for the things I wanted. Not so much for the things I needed, but if you wanted skates or a guitar or a new glove mitt or whatever it was. Growing up in a middle-class family, I learned to earn my own money at a very young age, which really offered me great discipline. My siblings and I were raised by the best parents in all of Wisconsin. And growing up in a very small boat building community, what I often saw was these huge freighters being built at the boatyards. And we also expected some of the best yachts to come out of a place called Palmer Johnson's. So looking at that and watching that as a child, I noticed that there must be a great world out there, and that really shaped my desires going forward. How I got into the business is an interesting story. In my very early teens, I started collecting coins. with winter in Northeast Wisconsin lasting about 7 months a year, you had to find different things to do. I was collecting coins, and I discovered that coins minted before 1965 were made of purely silver. And after 65, they made silver coins, which previously were silver, or now were made of copper and nickel, basically base metals. And I thought to myself, why did they stop using silver to make coins? And what I discovered was, silver is certainly a precious metal, and it was about to become more precious. And that's why they stopped using silver. Little did I know that a few decades later, those silver coin collections and trading silver was going to get me on CNBC and Bloomberg and Fox and Forbes podcasts like today. That coin collection certainly was parlayed into something really special, and that's how I got my start.
Wow, that's great. And as a coin guy, I need to ask, and I've not asked you about this yet, the idea of the United States sunsetting the penny. As someone who's lived or died by the coin, so to speak, what are your thoughts on that happening?
Well, fortunately, I don't have to collect copper anymore. I was collecting silver, but you got to collect a whole lot of copper to bring that to the bank and cash it in. I think a copper penny wound up costing about 4 cents for the government to make. So part of getting rid of government waste, I think that's what happened to the penny.
All right, good to hear. So you talked about this journey. You gave me a nice little succinct abridgment of like you falling in love with silver and then making it your life's work. But when did obviously you're early in your career influenced by markets. When did you stop reacting to markets and start anticipating them, which is what you are known for today?
My very first forte into futures was 1984, 1985, and there was an incredible drought in the Midwest. So as a youngster now in my early 20s, I'm noticing that it's not raining and the grass is brown and the ground is cracking. And I said, that can't be good for production of corn or soybeans. I took some of my money from my coin collection. I think it was around $7,500. And I went long soybeans on the idea that a drought was going to create higher prices. That summer, in about 3 months, I made 10x on my life savings. And I said, this is for me. I certainly didn't only like trading commodities, but I loved it. And that was my early start into turning, trading into real money.
And obviously, intuition is a big part of your career. But you talked about the data earlier. How do you thread the needle of like not pushing down the intuitive James Cordier, but allowing some of that data to come in? Or is it 50-50 nowadays? How do you balance the two of those things? Because obviously, you are in a world driven by data, but you still have that gut, which you mentioned there at an early age about how that can drive your decision making. So how does that work today?
Joe, I think our competition is reading the Wall Street Journal or watching CNBC. I love that newspaper and I enjoy that show, but the talking heads that come on, that is old news. When they're discussing a report that just came out or supply of coffee or soybeans or silver, the professionals were trading on that days and weeks ago. So really understanding the fact that what's in the news is kind of reporting what's in the rearview mirror, and looking at things like open interest and understanding that commodities do have a personality. Sometimes I wish I was in my younger days of trading, but the 3 decades plus that I've been trading these, you learn the personality, and I think that gives you quite an edge.
Nice. Going back to that point you made on CNBC Dubai the other day, just wondering, what do you feel when you make a call like that so publicly? Is it pressure? Is it like clarity? Like what are you actually feeling at the moment once you make that decision? Because me, James, I'm scared of my own shadow. So for me to say something that bold, I'd be pretty. What do you say? Quaking in my boots. What do you feel when you make calls like that?
Joe, that is an excellent question. And people say, oh, that's a great question all the time, but that was a great question.
Thank you.
Prior to going on CNBC Arabia last week, generally they invite you about 10 days in advance. And I knew I was coming on to talk about gold and silver and Brent crude oil. I knew I was coming on. And I'm saying to myself, gold is going up just in catastrophic way, just up $50, up $100 every single day. Silver is making moves that I would never have dreamt of, that it could go up that far, that fast. And I'm watching technical indicators leading up to the several days prior to me going onto CNBC Dubai. And I thought to myself, this open interest falling, this is all short covering. So I watched it each day prior to going on, because only an absolute lunatic would go on TV and say, oh, this is the high-end gold. This is the high-end silver. And I thought to myself, everyone is bullish this market. And am I going to go on and talk about open interest that no one really even understands, much less talks about? And I said, hell yeah. Open interest is falling 6 days in a row. This is not good breath for the market, and it's likely going to come to a halt. And it did. And Joe, it's interesting. I've been dubbed, I don't know where the heck this came from, but I've been dubbed the commodity market maverick. And perhaps this example of on CNBC last week calling it top in the biggest runaway bull market ever in history, maybe that's how I got the name. Perhaps it is.
That's great. Let's part of the pun. Let's dig into gold a little bit, since it was obviously top of mind and what you were talking about on CNBC. Big gold runs always come with like fear narratives, like war, inflation, dollar collapse. How much of gold's movement is economics versus emotion?
I think it's economics. It seems as though central banks around the world just don't have enough gold. And for the first time that I've been trading commodities decades ago, the price does not matter. And that's a very interesting landscape for commodities like gold. Central banks around the world, they simply don't have enough to make themselves feel comfortable. They would rather have hard assets than fiat currencies. You don't see that very often. A lot of the buying, I think, that took place in gold and silver, and I don't think gold and silver are done by any means. We did call a nice 30 and 40% correction in those two markets. But what's going on right now, Joe, is basically people owning crypto and Bitcoin. A lot of these people have become very disenchanted with the fact that it does nothing but go sideways to lower. I think it made a new 6-month low today. And a lot of people who invest in Bitcoin decided to themselves, why don't I trade in one Bitcoin for like 20 gold coins or 1,000 silver coins? And the fact that that worked, and it worked incredibly well, I think you're going to see that continue. I know gold and silver have readjusted to extremely much lower levels than it was just 2 or 3 weeks ago. But a lot of the people who used to buy Bitcoin, I think, can be buying gold coins going forward. And I don't think we've heard the last of gold and silver. It's very early in 2026 right now, and I wouldn't be surprised that it doesn't make higher highs than what we saw 10 days ago.
You mentioned crypto has that obviously volatility to it, but I think on the other side, the gold side is like people only understand gold as safe haven. Like that's the word a lot of people use. What are they getting wrong when it comes to just keeping gold as just it's safe? It's like having that savings account when you're a little kid. It's just safe. It adds up at the end of the year kind of thing. But what are people getting wrong with that sort of mindset?
Interestingly, Joe, I've had a lot of people comment on the call that we made in gold this past week. And they say, James, I really don't care. I don't care if it goes up or down. I'm holding this forever. It's in the safe deposit box. I'm giving it to my kids, and my kids will give it to my grandkids. It's a safety blanket. It just feels good. You put it in your hand. It's like, this is real money. And whether it's a 1-ounce coin or something larger than that, it's just something that people feel comfortable having. And versus, if you have $1 million or $10 million, there's 37 trillion of those out there in outstanding debt. So, how much is your currency going to be worth, whether you have $1 million or $100 million? A lot of people want to trade some of those currencies in for gold, and that's what we've certainly seen the last 12 months.
Cool. Let's shift over to your first love, and that's silver. You've been talking silver lately, a lot lately. Why does silver move in bursts while gold goes trend-wise?
Silver has about 1/5 the trading volume that gold does. And then you get to the affordability factor. When gold was trading at $1,500 or $2,000 and silver was at $10 an ounce, it's like, get the shinier, more pretty metal. I mean, it's still affordable. But when gold, raced above $5,000 an ounce, that probably takes a lot of investors and collectors out of that market. So when they're looking at silver trading, is at 90 or $100, it seemed quite inexpensive, relatively speaking. It's thinner. There's not the volume to trade silver that there is gold, and that's why I think it makes bigger bursts both up and down, like it did late last year and like it did last week.
And in the example of when silver explodes upward, is there a trend of what happens after? Like, is there like usually like the inevitable, oh, silver explodes, XYZ happens?
That's so interesting. I was watching one of the biz shows last week. Silver was down like 35%. And one of the analysts, one of the experts was asked their opinion about silver. And he just kind of like shrugged his shoulders, like he wasn't long. He didn't enjoy the rally. And then silver fell like $35 in one day. It was, it's commodities. Of course it's down 40%. He seemed like he did not participate in the rally because the fact that it fell 35, 40% one day, he didn't seem to care. So people watching commodities, if you're going to spend that much time and effort and work, you need to be invested in it because the participation and the returns that happened this past year, cattle market all-time highs, coffee market all-time highs, silver market all-time highs, copper all-time highs, gold all-time highs. It's an asset class that I think is going to win over a lot of new investors. We often talk about, the 60-40 rule, 60% stocks, 40% bonds. We truly believe it's now going to be 60-30-10, and that 10% being commodities. I think the commodity markets recently have won over a lot of new investors, and it certainly feels that way at our office.
All right, so let's shift over to that dirty little three-letter word, oil, which sits at the center of politics, wars, and inflation fears. What does the data say when the noise gets that loud as it is now?
It is. You have the U.S. Navy steaming towards Iran to see if they can't strike a deal before something, bad has to happen, militarily wise. Iran's not that critical. It's not that important, but that is where the headlines really take over. Crude oil recently, rallied some, $12 to $15 on Brent, rallied about $8 on WTI, which is U.S. oil. Oil's not worth that much in the month of February. Low demand right now. There's some signs that demand isn't that great. We expect oil to come off of these highs as some of this excitement about the Persian Gulf takes place. Oil doesn't go up in February. It does go up in February on the headlines, but it's not from demand. So we would expect the three-letter word oil to go back down March, April, and May. If it does that, we have seen percentages of when the stock market does well the previous year, how many people drive on vacation the following summer. And we think that a dip in oil prices in March and April might be a good place to put your tuxedo on and jump in.
I want to double click on something you just mentioned because every spike gets blamed on conflicts as they are now. And you mentioned the supply and demand. How often is supply and demand the real driver as opposed to these blurry headline things, whether it's Iran, whether it's Venezuela, whether it's Ukraine, Russia? How much is supply and demand the real driver as opposed to all this other noise?
The fact that oil is so liquid, pardon the pun, the volume, the open interest is massive. And the supply demand for oil does dictate the price. It goes up or down based on some headlines, but it does not stray far from its fundamental factors. Interestingly, about a month ago, of course, the United States took over the country of Venezuela, and everyone thought that, oh my gosh, we're going to be pumping an extra 3 or 4 million barrels a day. The market went down for one day, and then it came back to its fundamental factors. And understanding supply and demand, especially in things like energies, can be very lucrative. People get so excited on a Venezuelan takeover on the downside. One investment bank after the next was saying oil is going below 50, it's going to 45 and 40 on low demand. And we simply don't see that. And just as a lot of these big banks were getting quite negative on oil, lo and behold, the price went straight up. So follow the fundamentals. Anyone can do it. You just need to go a little bit past the headlines and dig in yourself. And you could be investing in oil and making your own calls if you want to.
Okay, cool. All right, let's move into the big picture. Trade wars, tariffs, dollar concerns, global tension. Which of these actually move commodities long-term, and which fades the fastest?
The tariffs fade extremely fast. There was the taco trade, and I'm not even going to describe what that is because I think a lot of people already know what that is. Tariffs are just negotiations just to create a deal, and those were very successfully created in 2025 and implemented, in my opinion. So tariffs don't last that long. What does last is just long-term trends, following OPEC and the production and following how high or how low they need the price to be. Generally speaking, everyone thinks the largest producers in the world want oil to go to $85 or $90. They don't want that because that is going to develop into a very large headwinds for economic growth around the world. And because we all saw what happened to oil, 5 or 6 years ago, 6 or 7 years ago, it went to zero. It only went to zero for about a minute, but it did. We don't need oil at $85 or $90. I don't think even the Saudis want it that high. I don't think the Permian Basin wants it that high. 70, 65 in the summer, that's high enough. On the low side, I think consumers like the idea that gasoline can be near $2 or $2.50. I think they enjoy that a lot. I think we're going to see crude oil go in a sideways market, likely for the next 2 to 3 years, with a low side of 45 to 50, and on the high side of 70 to 75. Everyone can live with that, both consumers and producers, and I think that's what you're going to see happen. So as the market dips, perhaps an opportunity. When the markets get too high, near 70, I think that's an opportunity as well.
Good. You're a peace and love guy because I've heard you say that you're not expecting that the world is heading towards a global war. So what is the real risk investors should focus on if it's not the war thing?
2026 has something going on this November, and that is the midterm cycle election. I would keep my eye on that. A lot of people are thinking that the stock market's doing extremely well, the economy is doing pretty good. There's going to be some tax rebates coming up. Someone that moves the market and can move the economy as well as the administration can and has. This November, things might change quite a bit. I think what we're going to see, Joe, is investors looking forward to November and thinking that, my stocks have done pretty well. Some of my investments have done quite well. The sell-in may go away. Generally speaking, investors and the market is about 6 months in advance. And if you add 6 months to May, you're right around the election. So sell in May and go away this year might be extremely popular and perhaps a good idea.
All right. And if you were to name the one commodity trend most people are positioned wrong for heading into 2026, what is it? Is it the oil one, or is there anyone else? Or can you pop another commodity out there that people you think are getting wrong about in 2026?
One thing that happened in 2025 is there was a big drought in one of the largest coffee producing nations of the world, and that was Brazil. And people were just buying, hand over fist coffee. Coffee prices are going up. They go to Starbucks and it's higher. A can of coffee at the grocery store is really expensive, and people were just bailing into coffee. It hit all-time record highs. And if they were just watching the Brazilian weather late last year, the beginning of this year, it has rained in southeastern Brazil practically every day. And while there was a bad drought last year, that drought is busted. And we're going to produce in Brazil, the largest coffee producer in the world, some 70 million bags. And buying coffee above $4 was not a good idea. But once again, people were chasing the news and chasing the excitement that everyone was talking about. And I think it's going to turn out that they got that wrong. Coffee above $4 is extremely expensive. It's likely going to be 33% less than that later this year.
I like to liken you to the Marvel superhero Daredevil, because he's known as the man with no fear. And so when fear dominates headlines, what's the indicator you trust the most? So you get the fear component out. What's the one indicator you trust the most when it comes to commodities?
Watch the open interest. It tells you who's buying for the long term. Those are considered strong hands. That is a bull market that can continue. Watch the open interest. Is the market's rallying? If open interest is falling, that is weak hands buying the market out of their bearish trade. And that is a short-lived rally. That's something very easily followed. Just have to do a little bit of homework, which we like doing. And our viewers that are watching this, they can do it too.
Awesome. So after decades doing this, James, what still humbles you about what you do? Because, obviously you're very good at what you do, but I'm sure there are some days you're like, oh man, I wish I had a mulligan on that one. What is it in what you do that still humbles you?
You know, you work on Saturdays, you work on Sundays, and you formulate a game plan for Monday, and you have a very good idea of exactly what you want to do. And then the market maybe trades in that direction just a little bit. And sometimes you feel, well, I missed it. Or all you've done is like you formulated a great plan and you've only missed 10% of it. So even if you're not, selling the high or buying the low, use your analysis. And that's what I've learned to do. Because if you don't do that, come Monday and the market's going your way already, or at least what you're expecting to, you may not want to jump into it because you think, well, I've worked on it all weekend. Why can't the prices be that way on Monday? So from time to time, I will hold back on a trade because I missed 10% of it. And I've got to definitely get better at that.
And so, for someone who's been doing this for so long, you've probably seen a lot of people come and go. What separates the people that have the longevity, the folks like you that have done it? What separates the people who survive as opposed to the ones who disappear? Are there a couple things or one thing that you notice that folks who come along, maybe with the shiny object syndrome of gold and silver, and then all of a sudden they've disappeared off the face of the earth? What's the big separator of those two?
Joe, I remember when I was approaching my first decade in this business, and people would say, my gosh, James, what do you do for a living? You trade commodities. And, oh my gosh, that must be so stressful. And it's a tiny bit stressful, but it's also euphoric. And I just love the idea of the excitement of what's going on in commodities. So often, longevity for a commodities trader is about 10 years. I've now going on a triple on that. And it's interesting how some people, this may not be their calling, but I love what I do, and I'm going to do this well into my next decade, if all goes well. And just looking forward to doing that. So many people get a couple things wrong, and they say, well, this isn't for me. But investing, and anyone who's managed any amount of money knows that losses are possible. It's investing. Investing is difficult. That's why when you go to large cities, it's the name of banks on the top of buildings. Investment isn't always easy, but commodities over the last year or two have really proven to be a great asset class for a lot of people. And that's what's going to keep me in the industry for a period of time yet.
And so for the folks like you that have been able to go past that 10-year threshold that you see a lot of people, is it just to Michael Jordanify it, is it the love of the game that keeps you around, that you just love this so much, and that other folks like you that have lasted this long? Because, like you mentioned, there's going to be ups and downs. There's going to be days where you were, looking through all the research over the weekend, and Monday comes around and everything's like, oh, I guess I just wasted my whole weekend doing that. Is it just the love of the game that keeps you this long into it?
Delivering alpha, Joe, is what keeps us doing this. The form of investment that can be created in this industry can deliver alpha in bull and bear markets. And that's where the magic is. I think the stock market was up 17% in 2025, but we beat that. Sometimes the stock market goes sideways. That's easy to beat. And believe it or not, the stock market can go down, and we can deliver alpha from time to time, not every year, but we can in bull and bear markets. And that's the magic that keeps us doing this and investing for high net worth investors.
All right, James, we're going to wrap things up here. But first, if folks want to find out more about you and what you do, where should they start?
They could visit the Cordier Commodity Report.com or JamesCordier.com. Both you could find out more information.
Awesome. James, that'll do it for this week's Cordier Commodity Report. Thank you very much, sir.
It was my pleasure, Joe. Thank you.